So we have question number 3 here. They are asking us to calculate question number 3. It's under stock valuation. So a company, ZAM Invest Ltd, has the following information relating to its ordinary shares. The company has just paid a dividend, which is D0, our current dividend of 4 kwacha per share. Dividends are expected to grow at a constant rate of 8% per year indefinitely. The required rate of return KE is 14%, or the cost of equity. The current market price of the share is 60 kwacha. What are we required to do? A. Calculate the expected dividend for next year, which is D1, using the Gordon growth model or dividend discount model. And also calculate the intrinsic value of the share. So here we have 2 questions. Let's see how we can do.
So we can start. We have seen that in question A there are 2 questions in there. One, they are asking us to find the expected dividend, which is D1, and also to come up with the intrinsic value. So how do we find the expected dividend using the Gordon growth model? So for number A, the expected dividend is given by D1 is just equal to the current dividend, then you open bracket, you say 1 plus the growth rate. Okay, so we have been given the current dividend. We are told the dividend per share is 4, then 1 plus what's our growth rate? It was 8%. In terms of decimal point, it's 0.08. So we are going to say 4 times 1.08. When we multiply here, what we are getting is 4.32. So 4.32, this is our expected dividend, or our D1. So now how do we find the intrinsic value? So the intrinsic value, or the true value of the share, is given by this. So we can just say we are trying to find the intrinsic value. So intrinsic value, the formula is simple and straightforward. It's just the expected dividends, of which we are calling D1. Then we are dividing by the cost of equity minus, or we can call this one cost of equity or expected return, and minus our growth rate, which is G. So what is our expected dividend? We have 4.32. Then we are dividing by the cost of equity, which was 14%. In terms of decimal point, it's like this. Our growth rate is 8%, which is 0.02. Okay, so yeah, we can punch everything. So 4.32, when I divide with what is down by saying 0.14 minus 0.8, this is giving me 72 kwacha. So 72 kwacha, this is the intrinsic value of the share, or the actual value of the share.
Then for question B, they are asking us to compare your answer with the market price and determine whether the stock has been overvalued, undervalued, or fairly valued. So if what we have found as the true value of the share or the stock is bigger than the market price, then we are going to say this stock has been undervalued. If what we have found as the true value of the stock is smaller than the market price, then we are going to say it has been overvalued. But here we can see that the market price is 60, then the intrinsic or true value we have found 72. So this stock is undervalued.
So we are comparing our answer with the market price. So the actual value, or the intrinsic value, the true value of the stock is 72, but on the market it is being sold at 60 kwacha, meaning it has been undervalued. So we can just say, since the true value of the stock, so since the true value of the stock is 72 kwacha and is greater than the market price. The market price of 60 kwacha. Therefore, this stock has been undervalued. Therefore, this stock has been undervalued. Yeah, that's all. So in the case, maybe here we found that the true value of the bond was 50 kwacha, we could have said it has been overvalued. But since the true value is bigger than the market price, so this stock has been undervalued.
Then for question C, they are asking us to calculate the expected return of the stock and break down the expected return into dividend yield and capital gains. So here there are two things. We are going to calculate the expected return of the stock. Then we are going to break it down into dividend yield and capital gain. So let's do that.
So how do we find the expected return of the share? So the expected return of the share is given by this formula. So we can say expected return is equal to, so this is just expected dividend, which is D1, over the current market price over market price, then plus the growth rate. So this is how we find the expected return. Expected return is in percentages. So yeah, we are saying it is expected dividend over current market price plus the growth rate. So for expected dividend, we already found it was 4.32, so we are just replacing what we have. Then the current market price is 60. Expected growth rate is 8%, which is the same as 0.08 in decimal points. So we can divide here and see what we are going to get. So when I punch on my calculator, it's giving me 0.72. Then we can add with 0.08. So this is giving me 0.152. So since we said expected return is a percentage, we can multiply this by 100, of which it is giving me 15.2% as our expected return. So now the question, they didn't end there. They said we have to show the dividend. We separate the expected return into dividend yield and capital gain. So for dividend yield, so if you want to find the expected dividend yield, it is just the expected dividend over the market price. That's how we find the dividend yield. Then capital gain, it's about the growth rate of the share. So let me just write here. I'm saying for dividend yield, this one is just the expected dividend over the market price. So what is our expected dividend is 4.32. What is the market price? It is 60. So when we divide here, we are going to realize that it's giving us 7.2%. So this is our expected dividend. Then for the capital gain we said is just the growth rate of the share. So yeah, capital gain is just the the growth rate of our share. So it is 0.08. Then in terms of percentage, we are just multiplying this by 100, which is 8%. So this is how we separate them into dividend yield and capital gain. And you see, if we are to add these two, it's still giving us the same expected return. So if you want, you can start by finding them individually. You say dividend yield is equal to expected dividend over market price. You find, then capital gain is just the growth rate that you have per year. When you add the two, that's what you're going to have as the expected return, which is 15.2%. So that's about question C. Okay.
Then for question D, they are saying if an investor buys the share at 60 quarter and sells it after 1 year at the expected price, calculate the total return including dividend received. Let me read once more. If an investor buys the share at 60 quarter and sells it after 1 year at the expected price, calculate the total return including dividend received. So here we are going to do that. We are going to find our expected price after 1 year since the price is growing at 8%, so we can do that. Yeah, then we are going to calculate the return from the capital gain and the dividend that we are receiving.
Okay, so we can go to number D. As we said, how can we find the expected price after 1 year? So the expected price of P1 is similar to how we find the expected dividends. It's the current market price, then you open brackets, we are saying 1 plus the growth rate. Okay, so the current market price, we have been told it's 60 and dividends are growing at 8%. Okay, so it's just going to be 60. We are multiplying with 1.08. So after 1 year, what's going to be the expected price for this share? It is 64.8 kwacha. Okay, so now in the question, what we are asked is to find the total return. Okay, so meaning how much is going to be our capital gain? You bought at 60 kwacha, after 1 year your share is now 64. So we can find our capital gain or our profit. So we are going to say capital gain is equal to the price after 1 year, which is 64.8 kwacha, minus the market price at which we bought it. So we bought this share at 60 kwacha according to the question. Then when we subtract, we can find that the capital gain is 4.8 kwacha. So for us to find the total return, we have to include also the dividend that we receive each year. Okay, so what do we know about dividend received each year? So for dividend received, in the question we already know that dividends, it's 4.32. that's the dividend that is received each year. So now in this case, to find our total return, we are just adding the two, the capital gain, the 4.8, plus the dividend which is being received. Okay, so we are saying total return is equal to 4.8 plus 4.32 kwacha, which is just going to give us 9.12. So this is the expected, this is the total return from this share. So just a quick recap, they were asking us to find the total return. So we say the total return is made up of two things, the capital gain and the dividend that we receive each year. So for capital gain, we said, okay, what will be our expected price after 1 year? So we bought at 60. After 1 year, we have found that it's giving us 64.8. So we can find what have we gained. We are just going to say 64.8 minus the market price at which we bought. We can see that we have gained 4.8. Then on top of that, we are receiving a dividend each year from our share, which is 4.32. So 4.32 plus the capital gain, then we can find our total return, which is 9.12.
Then when we go to question F, at question E, they are saying if the growth rate increases from 8% to 10%, calculate the new intrinsic value and explain the effect on the stock. So here there are two things. We are going to calculate our new true value of the stock after increasing the rate from 8 to 10. Then we are going to explain the effect on the stock.
So for intrinsic value of the bond, we know the formula since we used it also in question A. So the intrinsic value of the bond, intrinsic value of the share, we said it's D1 expected dividend over expected return from the market, or cost of equity minus the growth rate. So now here in this question we have been told that the growth rate is increasing from 8 to 10%. So we have a new G, meaning the 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 expected dividend is also going to be affected. So how can we find our new D1? So for our D1, it's going to be given by the current dividend. Then here we say 1 plus the growth rate. So 1 plus our growth rate. So what is our what is our current dividend? So our current dividend is 4 kwacha according to the overall question. Then the growth rate has gone to 10%, which is the same as 0.1. So it's more like 4. We are multiplying with 1.1, which is going to give us a 4.4 kwacha as our D1. So our D1 in this case is 4.4 kwacha. So since we have D1, we can now come up with our intrinsic value. Where there's D1 there, we are putting 4.4. Cost of equity is still 14%, so we have 0.14, but the growth rate has changed to 10%. We are going to put 0.1. So on top we have 4.4, then down when we subtract here, it's giving us 0.04. When we divide, we are finding that the intrinsic value of the stock is 110. Okay. Then they also told us to explain the effect of the increase in the growth rate. So what have we noticed? The intrinsic value or the true value of the stock has increased. In question A, we found 72 when the growth rate was 8%, but after increasing to 10%, we have now found 110 kwacha. So what can we say? We can say that the increase in the growth rate causes the stock price to rise, because the expected dividend here has increased also. So we can just say the increase in growth rate causes the stock price. So the increase in growth rate causes the stock price to rise. What's the reason? Maybe we can even say because the expected dividend increases. The expected dividend rises. Okay, yeah, so that's the reason. So we have observed that the increase in growth rate, it causes the stock price to rise because the expected dividend rises.
Then for question F, they are saying briefly explain the difference between book value and intrinsic value, why the required return affects stock price, factors that influence dividend growth rate in real companies. So this is theory. I'm going to attach my findings. Even you can put what you think is okay. Theories differ the way we think. Yeah, that's about question F. Then we can go to question G. So if the required rate of return KE increases to 16%, what happens to the stock price? Explain mathematically. Discuss the limitation of the Gordon growth model in emerging markets like Zambia. Okay. So here what we are going to do, we are going to find our new true value of the stock after increasing our KE. Then we explain, of course, what's going to happen. So it will depend on what we are going to find, if it will increase or if it will reduce. Then for the limitations, these are theories. I'm going to attach the limitation of the Gordon growth model.
Okay, so let's come up with the price of the stock after we have increased our E, the required rate of return. So this is question G. So we are saying the price of the stock. If you want, you can say the intrinsic value is one and the same. So the price of the stock, how do we find the intrinsic value? So we know that this is given by D1 then over required rate of return minus G. Okay, so in this case, what's our D1? We are using the actual one, the 4.32. Here what we are changing is KE. We maintain the G that we have in the question, and we know that when the growth rate was 8%, our D1 was 4.32. Okay, then we are dividing by KE, so KE has increased to 16%, which is 0.16 minus our growth rate, which is 0.08. Okay, so what's on top here? We have 3.32. Then what is down? When I subtract these two, it's giving me 0.08. So when we divide, what are we finding? We are finding a 54 kwacha. Okay, so what has happened to the stock price after increasing the required rate of return? The stock price has reduced to 54. So since the question also wanted us to explain what happens mathematically, so what you're supposed to do, first calculate and see what you have found, then you comment using theory. So we can say if we increase KE, the stock falls to 54 kwacha. So we can say if KE increases, the stock price falls to 54 kwacha. That's all. No need to write more. So yeah, if KE increases, the stock price falls to 54 kwacha. The questions also asked us to explain the limitations. So for the limitations, I'm just going to attach them here. This is theory. You can put the ones you are comfortable with, and also I'll put the ones I'm comfortable with since they are a lot. Yeah, so that's about it. Stock questions. So stock valuation, these are the questions that we are expected to find.